Assalamualaikum warahmatullahi wabarakatuh. Very good evening. I'm Mohd Shukri Hajinoor from the Faculty of Economics and Management, Universiti Kebangsaan Malaysia, UKM, the National University of Malaysia. Tonight we're going to learn from Chapter 12, Exchange Rate Determinations. These are some of the topics we're going to cover tonight. What determines exchange rates in the long run, in the short run, and in the short run we're going to see exchange rate overshooting, and lastly forecasting of foreign exchange. What determines exchange rates? Factors that cause the supply and demand schedule of currencies to change. There are two: market fundamentals and market expectations. Market fundamentals: productivity, inflation rates, real interest rates, consumer preferences for either imported goods or local goods, and government trade policy. Market expectations: news about future market fundamentals, traders' opinions about future exchange rates. Factors affecting exchange rates in the short run, medium run, and long run. In the short run, transfers of assets, bank accounts, government securities that respond to differences in real interest rates across countries, and shifting expectations of future exchange rates. In the medium run, it's got to do with cyclical factors, up and down the economy. In the long run, dominated by flows of goods and services, trade in goods and services, and investment flows of capital that respond to inflation rates, investment profitability, consumer taste, productivity, and government trade policy. From here, we see here is fundamentally driven medium run, cyclical path, medium run, cyclical path, and fundamentally driven long run, equilibrium path. And that can happen in the short run. There's technically driven short run overshooting path. However, this is the fundamental equilibrium path, this way. Now, in the long run, what are the factors affecting exchange rates in the long run? Number one, relative price levels. Number two, relative productivity levels. Number three, preferences for domestic or foreign goods. Number four, trade barriers. If US price levels increase, there's going to be depreciation. If US productivity increases, it's going to be appreciation of the dollar. If US preferences for imported goods increase, it's going to be depreciation of the dollar. If US trade barriers increase, it's going to be appreciation of the dollar. Rather than going through this, I'm going to go straight to the graph over here. These are the four factors in the long run affecting the exchange rate. Number one, relative price levels. Number two, relative productivity levels. Number three, preferences for domestic or foreign goods. Number four, trade barriers. Number one, relative price levels. Suppose price levels increases in the US. So products in the US becoming more expensive relative to, for example, the UK. So products from the UK is going to be more cheaper relative to the American products. So American consumers will demand more of UK products. As a result, it's going to be a shift to the right in the demand for pounds. At the same time, for the UK consumers, they're going to demand less of American products. As a result, it's going to be a shift in the supply of the pound to the left. As a result, American dollar depreciates from 150 to 160. That's number one. Number two, productivity level. Suppose there's an increase in productive level in the US, So the US can produce goods at cheaper cost, and as a result, relatively, products from the UK is more expensive. So as a result, consumers in the UK will like to buy products from the US, which is cheaper. As a result, there's an increase in supply of pounds, a shift to the right for the supply of the pound. And at the same time, American consumers will not be encouraged to import goods from the UK because it's more expensive in the UK, cheaper with the products from locally produced in the US. So as a result, the demand for pounds shifts to the left. So on and all, as a result, there's a appreciation of US dollar from 150 to 140 per pound. So when productivity level increases, there's going to be appreciation of the dollar. Number 3, suppose American consumers prefer more of imported goods. So as a result, there's going to be a shift in the demand for the pound to the right, and that causes dollar to depreciate. And that doesn't happen with the supply, only with the demand. That's number 3. Number 4, trade barriers. Suppose there's increase in trade barriers in the US. So in order for American consumers to import goods from the UK, they're going to have to pay more. So there is going to be a shift to the left, decrease in the demand for the UK pounds. So it's going to be appreciation in US dollar. So these are the factors affecting exchange rate in the long run. We can review that if relative price level increases, it's going to be depreciation. If productivity level increases, it's going to be appreciation. If consumers demand more of imported goods, it's going to be depreciation. If there is an increase in trade barriers, it's going to be appreciation. Law of one price. Identical goods should be sold everywhere at same price when converted to common currency. Assuming it is costless to ship goods between nations, there are no barriers to trade and markets are competitive. So prevailing market exchange rate is the true equilibrium rate. So Bergonomics, the Big Mac Index and the law of one price attempts to measure the true equilibrium value of a currency based on one product, the Big Mac, because it's sold all over the world. So can be used to determine extent to which market exchange rates differ from the true equilibrium exchange rate. Big Mac prices show law of one price does not hold across country. This is in the United States, Switzerland, Norway, the countries, and the price of Big Mac in local currency, $5, this is local currency, and converted into price of Big Mac in US dollar. So, same, less, much less, and this is so here that's overvaluation of the currencies. This is overvaluation, this is undervaluation, and undervaluation by percentage. Theoretically, it should be the same, 506, all 506, but it's not. So, purchasing power parity, theory that exchange rates adjust to make goods and services cost the same everywhere. This is an application of the law of one price. The law of one price, goods sold everywhere is going to be the same price. If the rate of inflation is much higher in one country, its money has lost purchasing power parity over domestic goods. Currency should depreciate to restore parity with prices of goods abroad. Here, according to the law of one price, if the yen price of steel increases by 10% and the dollar price still remains constant, then yen will depreciate by 10%. Will depreciate by 10% in order to ensure that price is the same in both countries. Depreciate by the amount of inflation, 10%. So depreciate by the same amount, by 10% as well. Trade flows are mechanisms that makes a currency depreciate or appreciate. Changes in relative national price levels determine changes in exchange rates over long term. Foreign exchange value of currency tends to appreciate or depreciate at rates equal to differences in foreign and domestic inflation. Changes in relative national price levels determine changes in exchange rates in the long term. A currency is expected to depreciate by amount equal to the excess of domestic inflation over foreign inflation, just like we've seen just now. A currency is expected to appreciate by amount equal to excess of foreign inflation over domestic inflation. So, the currency is expected to appreciate if there's by amount equal to excess of foreign inflation over domestic inflation. If domestic inflation is lower than the foreign inflation, so it's going to be appreciating. Purchasing power parity is used to predict long-term exchange rates. We have here the formula here. This is S1, estimated target at which actual rate should be in the future. It equals to, here we have the equilibrium exchange rate in the base period. So we have the relative of US price level over the base period compared with the next period over the foreign countries' inflation. Here, Switzerland, SO, S1 over SO. Exchange rate movement may be influenced by investment flows, but the problem is choosing appropriate price index to be used in price calculations, determining equilibrium period to use as a base. Government policy may interfere with operations of the theory. Forecasting exchange rate is only appropriate in the long run. Poor forecasters in the short run. So this purchasing power parity is better in the long run, not in the short run. So we have here yes, and this is appreciation and depreciation. And we have here price level. UK inflation rates against US inflation rates. This is exchange rate pound per dollar. Okay. Supposedly, it follows. Exchange rate should follow the relative price level. Increases in price levels will lead to increases, depreciation of the currency. But here, we're seeing here, in the short run, doesn't really tally. So, it only tallies in the long run. So, purchasing power parity is better in the long run rather than the short run, because it's here, this is the increase in price level in the UK, but exchange rate of the UK appreciate. This is not consistent with the theory. So again, we're seeing here, purchasing power parity is only suitable for the long run rather than the short run over here. Foreign exchange market activity dominated by investors in assets, treasury securities, corporate bonds, bank accounts, stocks, and real property. Today, only 2% of foreign exchange transactions for financing of export and import, but rather 98% are attributed to assets being traded in global markets. So, as a result, we're going to study about asset market approach. This is in the short run, I forgot to mention. We've done with the long run, now with the short run. So, asset market approach. Investors consider two factors when deciding between domestic and foreign investment. Number one, relative price levels of interest rates. Number two, expected changes in exchange rate itself over the term of investment. This is short run. In the short run, if US interest rate increases, so toward dollar-dominated assets, so appreciate US dollar. If British interest rate increases, so toward pound-dominated assets, so pound depreciates. No, we're talking about the dollar. So dollar depreciates. Expected future change in the dollar exchange rate. So, if expectation of appreciation of dollar, so it's going to be repositioning toward dollar-denominated assets. So, dollar will appreciate. So, relative levels of interest rate. Level of nominal interest rate is first approximation of rate of return on assets that can be earned in a particular country. Differences in level and nominal interest rates between economies is likely to affect international investment flows as investors seek highest rate of return. So, nominal interest rate. But investors are more interested in real interest rate. If interest rate in the US increases or bigger or higher than rates abroad, increase in demand for dollars. So dollar appreciates. If interest rate in the US is lower than rates abroad, decreases in demand for dollars. So dollar depreciate. What is more important is real interest rate, which is minus inflation rate. Nominal interest rate minus inflation rate. So, this is, we have here pounds, bill of pounds and dollar per pound. depreciation of dollar this way. So suppose relative interest rate, number A, relative interest rate in the US is higher than the UK. So it's going to be more investment coming to the US because of interest rate is higher in the US. So there's going to be more demand for, or this is the other way around. Suppose the UK has higher interest rate than the US. Now, interest rate is higher in the UK. So it's going to be more demand for the pound, because American investors will be going to the UK to invest in the UK. They will demand more of the pound. At the same time, there's going to be less supply of the pound in the US. As a result, there's going to be depreciation of dollar. So let me repeat. If there is higher interest rate in the UK, we're going to see depreciation of dollar vis-a-vis the pound. What about expected change in the exchange rate? So suppose investors are expecting exchange rate was going to be increasing in the US. So as a result, there's going to be more supply of pound in the US because UK investors will be coming to the US and they're going to supply more of the pound because they're going to need more of the dollar. So as a result, they're going to supply more of the pound. So conclusion for the B, if there is an expectation of in the future, it's going to be increased interest rate in the US. So it's going to be appreciation of dollar. So expected change in the exchange rate. Future expectations of appreciation of dollar can be self-fulfilling for today's value of the dollar. Long run determinants of the dollar's exchange rate leads to expected appreciation of the dollar in 3 months. So expected foreign exchange gain for UK investors. So UK investors investment flows to the US and dollar appreciates. Here we can see it in the graph. Dollar exchange value follows that of real interest rate, basically. Appreciate when real interest rate goes up, it's going to be appreciation of dollar. When real interest rates go down in the US, it's going to be depreciation of the dollar. Italics. However, in the short run, there's going to be diversification, safe havens, and investment flows. Relative levels of interest rates strongly impact investment flows. Other factors affecting investment flows among economists: size of stock of assets denominated in a particular currency in investors' portfolios. They consider both risk and reward may induce change in investors' preferences for diversification purposes. So there's also safe haven effect. Investors may be willing to sacrifice return for safe repository for their funds. For example, US was safe haven for Europeans worrying about the Greece 2010 bailout. So European invested in the US, so euro value was down. In the short run, that's going to be, remember, short run. overshooting of the exchange rate. Short-run responses, either depreciation or appreciation to change in market fundamentals is greater than its long-term response. That's what we call overshooting. Changes in market fundamentals exert a disproportionately large short-run impact on exchange rates. That helps explain why exchange rates depreciate or appreciate so sharply from day to day. Volatility of exchange rates intensified by overshooting. Overshooting is explained by tendency of elasticities to be smaller in the short run rather than in the long run. In figure 12.6, here, increased demand for pounds leads to initial pound appreciation, which is dollar depreciation. With US prices lower, quality of pound supply increases over time, dampening initial pound appreciation. Also can be explained by exchange rates tend to be more flexible than many other prices, such as wages, which are often written into long-term contracts. Let's go to figure 12.6. Here we have the initial demand of pounds and supply of pounds. Initially starting at $2 per pound, the exchange rate. This is the initially. So the response of in the short run, this is a short run, less elastic compared with the long run, more elastic. In the short run, the response of changes in market fundamentals, there's going to be overshooting. Depreciation in US dollar from $2 to 220. So overshooting there. However, in the long run, because of long run is more elastic, it's going to come down to 210. So here is overshooting in the short run. Because of short run supply is less elastic. Long run supply is more elastic. So in the long run, it's going to follow the long run pattern. So this explains to us what is overshooting, exchange rate overshooting. In the short run, there's going to be overshooting of exchange rate, either appreciation or depreciation. Here we're seeing depreciation overshoots the long-term trend, overshoots. Finally, in our topic, forecasting. Very tricky, especially in short run, necessary for exporters, importers, investors, bankers, and foreign exchange dealers. Choosing currency in which to make deposits require ideas of what currency's value will be. Decision about foreign investment necessitate awareness of where exchange rates will move over time. Need for exchange rates forecasting resulted in emergence of consulting firms. Basically, there are three ways of doing forecasting. Judgmental forecast, number one. Technical forecast, number two. And lastly, fundamental analysis. Let's go back. Judgmental. Subjective or common sense models require wide array of political and economic data, interpretation of this data in terms of timing, direction, and magnitude of exchange rate changes. Projections based on thorough examination of individual nations based on economic indicators, political factors, technical factors, and psychological factors. Technical forecasts involve use of historical exchange rate data to estimate future values, ignore economic and political determinants of exchange rate movement, founded on the idea of that history repeats itself, used to analyze short-run movements of exchange rates. Here are the methods deployed by some of these consulting firms. When forecasting exchange rate, technical analysts watch for new highs and lows, broken trade lines, and patterns that are thought to predict price targets and movement, up and down, and this is the target. Fundamental analysis, opposite of technical analysis, considers economic variables likely to affect supply and demand of a currency, uses statistical estimations of economic theories, attempts to incorporate fundamental variables that underlie exchange rate movements, interest rates, balance of trade, productivity, inflation rates. Fundamental analysis. Limitations of econometric models used to forecast exchange rate rely on predictions of key economic variables for which reliable information may be hard to obtain. Some factors affecting exchange rates cannot easily be quantified. Precise timing of factors' effect on currency exchange rates may be unclear. Currency traders generally prefer technical to fundamental analysis. Most forecasters use combinations of fundamental, technical, and judgmental analysis. Econometric models best suited for forecasting long run rather than short run. Models do not generally provide foreign currency traders precise price information when to purchase or to sell. Currency traders generally prefer technical to fundamental analysis. Most forecasters use combination. This is, I did it. Repeat, sorry. Exchange rate misalignment, deviation of exchange rate from fundamental value, has implications for countries' trade positions and job creation. Undervalued currency gives currency trade advantage at expense of trading partners. Undervaluation widely considered unfair. However, there is no sure way to estimate correct value of currency and thus determine the extent of undervaluation. And that's it. Thank you very much for watching.